Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. This is my continuing series where I'm going to cover all 11 sectors looking for value. And I've run a screen here, and I've got all 11 sectors screened, and I found different varying amounts of companies in each of them. My screen is I'm looking for BBB minus or better. I'm looking for companies that have earnings yields, or in this case, I'm looking at cash flow yields of 6% or better, and estimated target returns of at least 5%. So I'm just looking for a certain subset of companies. There's a lot of other screens I could do. I want to make sure you understand that. And there's a lot of other companies that don't have credit ratings or are not investment grade, et cetera, that can be found here. But the point is, it's a market of stocks, not a stock market. And I'm going to be covering that throughout this video. But right now, this will be on the energy sector. But before I do that video, in my last video, where I covered consumer staples, I inadvertently left out Walgreens, and I had a lot of people asking, a lot of people commented on it. So what I'm going to do here with this video, first thing I'm going to do before I get into the actual video, is I'm going to go ahead and cover Walgreens for you. So let's go ahead and turn to FastGraphs, and let's look at Walgreens Boots Alliance. I like this stock, and I like covering this stock because as Mr. Valuation, this stock really gives so many lessons and so many proofs of how valuation actually works. What I want you to note here is during the recession of 2001, all the way up through until this recession of 2008 and 9, this company was overvalued. And I want you to note that this was a time where the business did really well. Earnings grew 16%, 13%, 16%, 18%, 12%, and 18%. From 01 all the way through 07. And the stock price was really highly valued. The PE ratios were in the 30s and 40s for much of this time. These were very high valuations. And frankly, the stock went nowhere. And if I kind of measured it from peak to coming trough into the Great Recession, you'd have actually lost money owning Walgreens for this period of time. So it was a case where the business did fabulous, which is something I talk about all the time. And yet the stock price really languished simply because it was facing the headwinds of overvaluation. Then it got attractively valued, and that led to a period of excess return on the stock because the stock then became very highly valued in 2015 before once again reverting to the mean. And then we kind of came into the COVID situation, in 2019, which we see here. And the stock price has been languishing ever since. It's been a very undervalued stock for the better part of the last 2 or 3 years. But the stock is starting to move back into alignment. It offers a 3.5% dividend yield, earnings yield of 9.5%. The company's BBB rated, has about 53% debt on the balance sheet, and it's got a really good dividend record too. I think that's important to talk about. When you look at their dividend has grown at double-digit rates through this whole 20-year period that I'm showing you right here. So very interesting company. I think it's very attractively valued right now. As for disclosure, I'm long this stock, but I'm also long CVS, and I use them interchangeably. Now, this is a consumer staples company where CVS did not show up in the screen I did when I got Walgreens because CVS is considered in the health services sector. So it's actually a different sector, although they're very similar companies. Anyway, that's Walgreens Boots Alliance. I apologize for missing it in the last video, but there you have it. So now to move on to the energy sector, I'm covering all the sectors. Now, the idea behind this was, given to me by my great subscriber, Golden Turd Zenaru, and he asked me to, provide a screen of all the sectors where I could find valuation in all the sectors. He asked specifically for 3 companies in each sector, and I've actually found slightly more than that. However, in the energy sector, I only came up with 4 companies, and I'll get into that in a moment. But I just want to revisit the S&P 500. It's a classic example of how overvalued the market is right now. Operating earnings growth is normal, semi-cyclical. We've had, 12% and 9% growth forecast in the future. We had a really good year in 2021, but that's coming off of, the down year of COVID. So that's kind of, getting back into trend line. The S&P 500 grows about 6.25% a year. And right now we have the market trading at these really nosebleed valuations. But in the theory that it's a market of stocks and not a stock market, it's important to remember that there are stocks. Now, there are very few in the S&P 500, but there are stocks in the overall market that are attractively valued. And so what I did was I went and ran my screens on the energy sector, and I came up with actually all oil and gas storage and transportation companies. I have 4 companies here. One of them is showing up twice because it's listed on both the New York Stock Exchange and the Canadian Exchange. That's TC Energy Corp. But you got Magellan Midstream Partners, Kinder Morgan, which is not a partnership, it's a C Corp. It's the only one of this group that does not have a K1, I might add. And then you have Enterprise Products Partners. So these four companies came up, if you will, on the screen. And I think they're all very attractive, but they all share a very similar attribute, if you will. They're all high-yielding stocks. If you look at the dividend yields, you see they're ranging from a low of 5.64% for TRP. That was on the Toronto Stock Exchange. That's in Canadian dollars. It would average about 5.8% on the U.S. exchange. But then we got 8.6 for Magellan Midstream. We got 6.25 for Kinder Morgan. And then we got 7.69 for Enterprise Products. Now, when I look at these companies, I think it's important to point out that because they are about the dividend and about the income, earnings are not such a big deal. I've talked about this in the past in previous videos. When you're dealing with these MLPs, and I'm going to quickly go into fund graphs here and point something out for you. When you go into the in millions graph and go into the cash flow statement, you will see that there's an attribute that these companies have that is really interesting. I said cash flow statement, I meant to say income statement, and that's the common shares outstanding. And I want you to see that, because what these companies tend to do is they tend to issue an awful lot of stock because they're constantly raising capital, buying properties, building new pipelines, etc. So they tend to be very, very dilutive. But in the same vein, if you look at the companies from a point of view of sales and revenue, they do generate a lot of revenue, and therefore their per share data, when you look at them from a standpoint of earnings per share, does not really look that attractive. It really comes down to what's the cash flow, and is the cash flow covering the dividend? And for Enterprise Products Partners here, you see that since, even before the recession, they've been generating a lot more cash flow than they have needed for distributions. Their payout ratio is around 65%. They offer a 7.78% current dividend yield if you bought it today. The cash flow yield is over 15%, and you can buy them at around 6.5 times cash flow on today's price. The stock is obviously very attractively valued. It's starting to move back into alignment. In this case, you could, I think, very intelligently argue that you want to pay no more than about 10 or 11 times cash flow to buy this company. And of course, you can buy it at under 6 today. So it looks very, very attractive here. The next company I'm going to cover is Kinder Morgan. Really an interesting case here because, number one, Kinder Morgan was an MLP, and they had a group of companies there. I can't remember all the names of them now, but you can check it out when you do your own research. And then they decided to go public and become an MLP. Okay, when they first came out, their stock was actually pretty highly valued. Now, as a result of this, the fact that they are a C company, it's interesting to look at them from a standpoint of earnings per share, in my opinion. And they came very, very highly valued. And then, it was inevitable that the stock was going to move back into alignment with earnings, and it got real close in 2016, and then kind of languished again sideways for a while. And then in the last couple of years, it's been trading in alignment with its actual earnings. So the company is finally maybe reasonably valued. It's kind of got a bit of a spotty earnings record. If I shorten this time frame, I want you to see that their earnings growth has actually been negative, since 2014 and so. So this is a tricky one. It's a C Corp. The good news is it doesn't have a K1. They did slash their dividend shortly after they went public, but they've been raising the dividend or paying the dividend, ever since. So if you look at it from a standpoint of operating cash flow, as I think you rightfully should look at these, high-yielding MLPs, or in this case, a C Corp, you'll see that the dividend is being very nicely covered by their cash flow. So Kinder Morgan, probably for the first time since they, decided to convert to a C Corp, they become attractively enough valued to where I might even want to take a look at them personally, but otherwise I've avoided this one. The next one I want to show is Magellan Midstream. Very nice, consistent record. Cash flow has covered dividends the entire time. Offers almost an 8.6% yield currently, trading at a very highly discounted valuation. Once again, something around 11 times cash flow would be a normal or a decent valuation, or even slightly less than that. The stock is currently trading at 8.88 times cash flow, so I do consider it to be on sale and very attractive. if you're looking for current income, then this might be a really good choice. Dividend growth has been, good, but it has slowed down quite a bit in recent years. You should be aware of that. But that's coming through COVID and all this other stuff. In the energy sector, of course, it's kind of a political football right now. But that's Magellan Midstream, very attractively valued, high yield, 8.57%, trading at a discount to its theoretical fair value. The final one that I want to show you is TC Energy, and I'm going to look at it both. I'm looking at it here in Canadian dollars. This is what it looks like as a Canadian company. Very, very strong cash flows covering the dividend, probably one of the lowest payout ratios of the group. 5.5% dividend yield, 8.86 blended price to operating cash flow yield of 11%. But I don't consider this one undervalued based on historical norms. I consider it fairly valued. Now, looking at it from the standpoint of the New York Stock Exchange, we get a slightly different picture, but very similar picture. And the difference between these two graphs is currency and exchange rates. So we got a slightly different yield, slightly different valuation, but whether you buy it on the New York Stock Exchange or the Canadians, this one is attractive but not compelling compared to some of the others that I've showed you. So there's the energy sector. I only come up with 4 names in the energy sector. They all tend to be income stocks. I think that's really important. So you might want to take a look at these, especially if dividend income or it's really a dividend distribution when you're talking about these companies is important to you. Anyway, this has been Chuck Carnival saying thanks for watching. As always, I appreciate you guys. If you like the video, ring the bell so you can, get notified of future videos. Subscribe to the channel if you haven't already. You might want to take a closer look at Fast Graphs, the Fundamentals Analyzer software tool. And you might also want to follow the links below the video here. If you haven't seen the previous videos in these sectors, you might want to take a look at them. This will be a series of 11 videos when it's all said and done. And then finally, take a look at the Fast Graphs Value U Academy. We're actually starting to post investing lessons and financial reporting lessons on the Value U Academy. It's a free offering we're doing. It's available to everybody. Our goal is to help you learn finance and become better equipped to handle your investments as well as to understand how to analyze your investments, etc. This has been Chuck Carnival saying thanks for watching.